think that we can start to creep some duration into the bond portfolio and have it be worthwhile, right? So cash is king at the moment because we're still adjusting to this liquidity shock, this tightening, this increasing rate. We're still waiting for the growth shock to manifest a little bit. And we're not seeing any kind of bond response that's sort of more typical of the previous 30 years minus the last 9 months. Mm-hmm. And so when do you think we're going to get to a point where bonds are going to offer the longer end of the curve, the duration is going to offer enough enticement to start to think about incorporating that into the portfolio in order for, I don't know if there's a deflationary response that comes of this down the road, if we kill growth that much that we get into that stagflation or that disinflation with the inflation side of it, where everyone's running back to the 30-year in order to preserve money. When do we start to incorporate some duration into the portfolio, do you think?
It's my favorite question. And I think we've done a great job of making sure, our clients haven't, pissed away their life savings with, buying bonds at every dip lower. We made a few mistakes on the long side of the bond trade this year, namely in March and no, actually pretty much in March. I think that was the only real mistake, major mistake. But answering the bond question, the duration question specifically, to me comes from two questions. One is the growth outlook really evolving in a really materially adverse way that would catalyze investors to really start to price in, material change and material inflection in Fed policy, not just a pause, but more importantly, rate cuts, et cetera, et cetera. We're not there yet. Ani, if you could throw this chart up, there's a couple of charts I'll use to answer this question. But on the domestic side of the equation, the bond market does not yet believe that an actual recession is the modal outcome. And the reason I say that is we have not seen the inversion that you typically see in the 3-month, 10-year yield curve ahead of recession. I mean, this thing has a 100% track record in predicting recession. And from my perspective, the researcher's perspective, I think Campbell Harvey wrote a great paper on this in the 80s, and it's still the conclusions still hold true, which is, this is the countdown clock to actual recession. And so the lack of inversion here tells me that the bond market itself is really not that concerned about growth yet. And now it will. This thing was 12 basis points from inverting, when I updated this chart the other day, that it's going to invert. And once it inverts persistently, not just like ticks a basis point below zero, once it inverts persistently, it'll start to send signals to investors, lenders, people in capital markets, business owners to start doing things and behaving differently. And then voila, 12, 18 months later, you wind up in a recession. I think a lot of investors were wrong-footed in June, and I would put ourselves in this camp in thinking that a recession was, going to be more imminent, like let's call it end of 2022, so early 2023. And what we've learned throughout the summer, or at least what we, 42 Macro, has learned throughout the summer by sequencing all the data and reacting and observing all these trends, is that the economy, coincident to lagging indicators, booming. It's going to be a while before we get into an actual recession. So that's one part of the answer to your question, Mike, which is, we got to wait for the bond market to get concerned about growth before duration is a legitimate, before, we can find a real floor to the price of long duration securities. The other side of the answer to your question comes from abroad, which is the inflation shock, really, and the response to the inflation shock from a policy perspective in Europe. What we're showing you in this chart, we're showing the red line up here is the Citi Eurozone Inflation Surprise Index. And so it measures, kind of the deviation in surprises when inflation data are reported. So higher means you tend to have more surprise, more shock value. And as you relative to the U.S. Inflation Surprise Index, which is blue. And as you can see, their inflation problem from a surprise perspective, from a shocking perspective, is much bigger than ours. And as a function of that, we're seeing a 3 to 4 sigma rise on a trailing 3-year basis in 10-year German Bund yields that are, contributing to the rise that we're seeing in 10-year Treasury yields and abroad. Fixed income markets are very global in nature. It's not like stocks where like there's a real significant home bias. Investors in fixed income markets are going where there's the best rate of return on a risk adjusted and financing basis. And so, in terms of the all-in cost of capital, and so this is having a significant impact on the kind of bond markets globally. I want to say this week alone, we've seen Germany authorize a 200 billion euro package to finance or to help finance their sort of fight against energy price inflation in terms of providing subsidies for consumers. I think that's somewhere around 5% of German GDP. France with another $100 billion package. That's like a 3% of French GDP. So there's a lot more supply coming online from a European bond perspective. And not only is that supply coming online in terms of the expansionary fiscal policy, we're seeing, contractionary monetary policy over there as well. So
it's amazing. It's amazing.
It's causing problems in global fixed income markets. Who the hell needs to buy these securities? No one needs them.
Yeah.